HedgeNordic, your single access point to the Nordic hedge fund industry.
In this interview, Eugene from HedgeNordic discusses with Ola from Taiga about their high conviction, downside protection focused investment approach. We hope you enjoy this discussion. To start with, can you tell us a bit about Taiga Fund and your investment approach?
The Taiga is synonymous with lush growth in a harsh environment. And just like I think it is a surprise to many that the largest and most important forest in the world is way up north from Scandinavia through Siberia to Canada. I think that the effectiveness and the attractions of slow but steady growth over time and predictable returns is a surprise to many investors. So our fund is built on our conviction that the markets can seem to be driven by liquidity and sentiment, which creates fluctuations and even large, significant major movements in the stock prices. What determines stock prices over time is the company's profitability and their growth. That's the foundation and our conviction that that's basically what's going to pan out, but that's over the longer term. So we also think that the combination of good value with earnings per share growth is most often found in the small cap space. So that's where we operate.
You already mentioned that you focus on small cap stocks. What kind of companies are you looking for among those smaller companies?
So we only invest in companies with mature businesses, with strong balance sheets and cash flows, with a business model that protects the company from external risk factors. In terms of the products and the services that they offer customers, they need to be sustainable value propositions over time. So, measurable markets that they are operating in with products or services that we believe will continue to be in demand.
And you have opted to manage but a concentrated portfolio. How concentrated is it, and what is your reason behind this concentration and focus?
Well, it's fairly concentrated. It's the 10 largest positions in the portfolio will typically represent 60% of our NAV, or 80% of our long book, and we believe that with our risk management process and restrictive criteria for selecting stocks and a high conviction hurdle in terms of making investments and making them significant, we believe that we have downside protection in each of our positions from a fundamental perspective in terms of the threats and the challenges that naturally every company is facing. But I think that there is another aspect, which is the portfolio construction, where we do think that we, with a diversified portfolio across those 10 names, provide sufficient protection against threats to the sectors that we may be looking at, or specific events that will affect certain businesses or commercial activity or even economies from time to time, and from that perspective, I think that it's a reasonable diversification, even if it's a fairly concentrated portfolio.
And as a long-short equity fund, what is the net market exposure that you seek to maintain on average, and what does it depend on, and how do you reduce it?
Well, our average net equity exposure has been between 50 and 70%. And so to some, that's not a big variation. You will almost not find outliers outside of that range. I mean, you will, but we've been operating for 13 years, and I think you can count it on, if not one, maybe two hands in terms of the number of months we've been outside of that range. So it's fairly consistent, but within that range, there are variations, and in order to quickly change our exposure, I think the short book serves a purpose in that it is a far more liquid portfolio than the long book, where we are able to change our exposure very quickly.
You clearly focus on low valuations, right? And despite value being out of favor, you still managed to do so well over the years. How do you explain this strong performance despite value stocks kind of being out of favor?
Well, I could be tempted to agree that we have indeed met our return targets despite market conditions rather than because of market conditions. But I think that we don't pay so much attention to what markets generally don't like, what type of style works, and how you define value versus growth. We have been what we are all the way, and we've always said that the way that we do it works in all of the environments that we have ever experienced, meaning finding companies with the qualities and with the prospects that we value will produce returns.
HedgeNordic, your single access point to the Nordic hedge fund industry.